Hi, so today's presentation is about inflation and an ancient story about debasement of currency and how what happens then can teach us something about what happens today. So, the case that I'm going to do here is analyzing an happening in Europe called Kipper and Wipper. So, this is the story in Germany as of 1620, so 400 years ago. And this is what happens when money breaks and why investors should care uh, until today, so to speak. And what I want to show you is that maybe history do not repeat itself, but at least it rhymes. So this will be an example that really can provide you with some deep understanding about such topics like macroeconomy, money printing, central banks, etc. So uh, why I'm doing this is if you understand how money breaks, then you can position yourself before it actually does. So basically, every major wealth transfer through history follows monetary stress, and basically inflation. As you know, as of today, we have a lot of inflation, and we have had that since 2020. And when the pandemic hit us, inflation is not an accident; it's a policy outcome. So it's someone somewhere that are pushing the inflation, um, and yeah, inflation is basically a tax on everyday people. And what I want to show you with the Kipper and Wipper is that this happening really shows the mechanics of inflation and how it can be created artificially. So this is one of the first cases in Europe which really proves this point. So what is or was Kipper and Wipper? So this was in a crisis in Central Europe in the early 1620s, and this was when they had something called the 30-year war, and government there financed the war through debasement of currencies. So what they did was they clipped coins, melted, diluted, and reissued the coins as new ones. So, for example, Germany, it wasn't like one unified country; it was like 30 countries in one country, and each of them had their ruler, and they had mints that could print money. And they said, well, to win this war, basically, we need more money, but we don't have enough coins, silver coins. So what we do is we clip through the edges of the coin, and then we melt it and do new coins with less content of silver. That way, they can have the same amount of silver, but triple the amount of money short term. So that was the plan. So this provided with short-term liquidity, something very important to fund wars. It's still important, as you have heard. A lot of people was talking during early September 2025 that we might end up in a liquidity crisis soon. That is also what some experts are saying pushed the Federal Reserve in the USA to lower the rates once again, despite having that sticky inflation still going on. So basically, short-term liquidity, but this debasement of currency during the Kipper and Wipper that led to long-term chaos. So basically, if you have weak institutions and you add wars to that, quite often that end up in monetary shortcuts. And it was in 1618 when the 30-year wars started, and they did not have any modern tax systems like we have today, so they needed to find a way to fund the wars, and they couldn't just increase the rate of taxes on the people. It was like too high already, so they needed to figure out something that was easily done, and how they did this was through starting to have more mints that could print more money, or in this case debase the currency, and through that they could uh, have a lot of velocity of less valuable money, which they could pay to soldiers, etc. And yeah, you can say that money in this time was based on trust and on the metal content, the way how much it weighed, etc. And it was quite stable before 1920 in terms of silver coins. But during 20 to 21, the war started to accelerate in this part of Europe, and the money wasn't enough. So what they started to do was the mass debasement, and more means going around to all these local places, like small countries, you could say, that wanted to win the war, and everybody wanted to import good, and they wanted to import good metals, and they wanted to export the bad ones. And this basically led to collapse, riots, famine, etc. And you could say the focus was on liquidity first, and the pain came later. So, more specific, how this debasement worked. So, good coins, they were identified and removed. Then they was melted and mixed with base metals. They were reissued at the same face value. So they wanted to still pay a soldier one silver coin, despite triple the amount of silver coins with the new cheaper metals. And what happens often was that bad coins were exported to neighbors, and this is obviously a sort of a deception. And if we want to have a law that really explains what this is, then you can analyze something called the Gresham's law in action. And this law basically means that bad money drives out good money. So the bad money, the velocity of the bad money will just keep increasing, while people will hoard the good money because they don't trust the bad money anymore. And this basically means that the spending became are not rational anymore. So it starts to grow an inflation. Uh, so in a way, it's this is not stupid. This is just how the psychology of money works. Um, but of course, this led to a lot of social consequences during the 1620s. The short-term solution with the basement of currency wasn't sustainable long-term. So prices of food just skyrocketed. Wages, they lagged behind. Some of this you can feel now during 2020, 2025. Um, Trade breakdown, riots, unrest, famine. At this time, the famines were quite severe. Millions of people died, so it was a lot worse than it is today in Western Europe. Then we see in some countries like Zimbabwe, etc., that hyperinflation really has caused similar happenings like here. Also, we had like between World War One and Two in Germany, the fall of their currency marks, the German mark, I think it's called, and that was also caused by similar funding a war machine. Uh, and obviously, the people that were affected the most were peasants and wage earners. So we see that it's quite of similar today. I will deep more into that later in the presentation also, why some people get more hurt by these policies like this, and some get better unscathed. So you can say that if you don't have any asset protection and you have debasement of currencies, you will have problems because the asset will go up in price, and the money you're left with will be worth less and less. And it was food inflation that were hit the hardest. So I already here we can see a lot of similarities from the 1620s crisis, and compare that Kipper and Wipper with today. So here we can really see that the history is starting to rhyme. So what they did in 1620s was coin clipping. And what we do today with the central banks is balance sheet expansion, buying bonds, etc. We know that a lot of the central banks in the world, especially Japan and USA, really are getting that debt to sky high levels. I think just the interest cost of the United States debt now is like the third highest cost for the government, almost the same as Pentagon. To give an example, at the 1620s they had silver dilution. Today we have purchasing power dilution. In 1620s we had more and more mints, more and more money printers, you can say. And now we have the fiscal and monetary overlap. And what they did back then was hoarding the good coins, making the other coins more less and less worth, getting a lot of coins getting stuck with the hyperinflation. As of today, people are buying assets to protect themselves instead. So the asset price is starting to get higher and higher just to protect people. So there are a disconnect between real value and real output and the actual asset prices. So that is something I want to provide you. So if we connect this to modern monetary policy, so as of today, we do not have like the silver coins and the coin clipping situation, but instead we have something that is called QE, quantitative easing. So that is, you can say that the Kipper and Wipper situation was an early example of QE. And QE is something we have talked about in this channel, how central banks are expanding their balance sheet to have the liquidity going into the marketplace, providing capital for the market to leverage and make it possible for innovation and for companies to have cheap debt and for governments also to spend money. So that is that. Modern monetary policy also explains negative real rates, and that is something, for example, that we have had in where I live in Sweden for many years. And what that makes is obviously a very inflated house market, as one example. Also, it's easy to borrow money to invest in the stock market, so that's another example. You get those kind of strange effects, and also what you call fiscal dominance in terms of government spending, etc. So the goal at the moment, when we have the modern monetary policies, is to buy time, but it's not to fix the structure behind to have the long-term sustainability that I think every one of us deserve. So you can say that inflation is a sort of a delayed taxation, and the more inflation you have, the more delayed taxation you get. And the problem with building in the inflation in the economy as we do now is if we just increase the rates too much, the financial system just can't keep up because there are so much debt, I think, out there, basically. So what we say here is that debt can be a tool, but it can also be a trap. So you can have productive debt, and that is basically infrastructure, technology, innovation. Where a television now is amazing. You can have $400 to $500, and you can have a great TV 65 and the area 65 and sharp screen HD, etc. And back in the days, you had like a useless television for um, uh, about $7,000. So that type of situation is really useful. But also you have unproductive debt like welfare promises, demographics, rolling deficits, etc. And when you push the debt too much in rolling deficits, you want to have that welfare state and social programs, but you can't afford it, and you borrow money to afford it rather than having um, taxation, and people work for it, then you will have a problem long term, and that is bad debt, obviously. And you can say here that this Kipper and Wipper logic still applies. So we have, for example, USA and Japan, with USA having the reserve currency privilege, and Japan obviously have the stability through their domestic savings. So both these countries rely on monetary flexibility, but their debt are getting so high that in long term the systems is not really sustainable. So we have losers and we have today's winners and losers. The losers today is quite similar to the losers during the 1620s. The losers are cash holders, wage earners, renters, fixed income households, etc. These people are the people that you hear out there complaining a lot now because it's more expensive when you rent something, it's more expensive when you buy food, it's more expensive everything's more expensive, and the cash you have earned through hard work is getting less and less worth every year. I think during 100 year period, the worth of your money is getting almost um, devalued to zero, like 98% or something. So in the long term, you can't hold just cash. You have to spend your money or invest in assets, etc. So that's the type of system we have. And if you're an investor, you need to understand that of course, in a 10-year span, despite the inflation, it can be great to have cash, because you can use that cash to buy certain things when the market are um, getting down, and it's some kind of crisis out there. But the people that have a lot of cash, they have the cash in certain places like bonds, etc., so that they at least secure their cash towards the inflation. They just don't have money under the bed, for example. So uh, most often they have at least 3 to 4% dividend on the cash that they save, so they don't lose out against the inflation. So that's the start. While normal people who just saving cash, they actually get less and less for the money each year. Um, so the winners, obviously, then is asset owners, businesses with pricing power. This we have really seen lately. For example, semiconductor companies. At the moment, we have Micron, where they have just increased threefold their price on memberships 2025, because they have that leverage at the moment, based on the AI spending spree that we have. Even though these type of companies obviously need to be careful, because the market can swift, etc. So you have to balance. But that is the type of companies that really are winning these type of uh, situations. Also, debtors with fixed liabilities like banks, etc. They win in this area, and there's something to keep in mind. Assets, they always adjust faster than wages. So if you are someone that if the inflation is 10%, your wage is probably not going to get 10% higher. I think most of us know that since 2020, a lot of the aggregated inflation the years is like 30% for many, and maybe the aggregated wage increase is 15%. So a lot of people actually has less money out now in terms of purchasing power, and that is something that we need to be critical of. And that is why we are losing when we're having this type of taxation through inflation. And Clipper and Wipper, it was the same back there. It was the peasants, the workers out there that really got the worst coins, because the velocity of a coin meant that the what they call the normal people, they got the worst coins. So they in the end couldn't even buy bread for their money. So it became famine, etc. While some people who had a lot of money, they could just stack the best coins or buy assets for the best coins before they became useless, and just relax and even gain some on the crisis. And a lot of them even got promoted up to a government level later on. So that is quite amazing, and maybe not the type of reward we should do, but is actually quite similar today also. So you could say that inflation is still regressive. So prices, they rise unevenly. So essentials increase first, and that is what everyone needs, and especially people with that just live paycheck to paycheck, they will get hit harder. And then the demand front loads. We have a quality that gets deteriorated, and eventually the sort of hoarding behavior just emerges. And we did get see a lot of this during 2020s when the pandemic hit, different type of hoarding behaviors. But yeah, I think we still see it today with people just pushing money into assets, different assets classes like cryptocurrencies, gold, silver, um, stocks, etc. And obviously, I have this channel here to show you how the reality is and why I am an investor. Obviously, I know this is the place we are. We have been in this type of situation since the 1600s, obviously. So things are not going to change drastically, and that is why I have some of my money in asset classes to hedge against that. That is just the reality of being a human at the moment. So instead of fighting that, maybe you should, or you could, make use of it. That is a part of why I'm having this channel here at YouTube, to discuss this sort of predicaments. So you have to watch behavior, not just KPIs, because it can be hard to just look at specific KPIs. So look at the bigger picture. That is something I want to uh, bring forth with this video. And a bit of a warning sign for investors in the future is that persistent negative rates that we have had in Europe, but also different countries. Uh, this leads to political pressure on central banks, and we also see similarities in USA, and Japan, etc. in Asia. We have that leads to, with the pressure on central banks, leads to assets inflation. And if that inflation is bigger than the productivity, then we have a problem. And often it leads to social polarization if we have the historical perspective. And I kind of feel like this is a moment we are in at the moment. And you can say that these three events often precedes what they call a monetary reset. And yeah, keep that in mind. Are we heading to a monetary reset now? I think we are getting closer, and we need to really stay focused in this specific moment. That is what I want to say. And the lesson from this is that capital misallocation. These type of policies like debasement leads to capital misallocation. Instead of having that fruitful allocation through companies, really getting the best companies get the money. Instead, we have too much money, and it gets just to everyone, and we don't have the best business models out there winning. Also, if you see a lot of buybacks instead of companies pushing R&D, research and development, that is also a sign that we have maybe too much liquidity out. And we have seen some of this, I would say, the latest 2, 3, 4 years. A lot of the biggest companies in the Nasdaq has really increased their buybacks. When they do that, they buy their own stocks to give more back to the shareholders. But that could also be an indication that that we have too much liquidity out there. It's too hard to even make use of the money in R&D. It's a sign of something, so be careful when we see that. That might mean that the companies don't even have to innovate to keep being on top, because of the unfair advantage some companies get in this type of environment. Also, real investments tend to underperform in these environments. Inequality obviously accelerates because it's certain people have or own the assets, and when you have too much currency debasement or too much money getting pushed out through balance sheet expansions, and the liabilities of governments gets too high, the assets owners will always be the ones that get their pie secured. And that means that the richer will get richer, and the poor people will get poorer, and people will get angry, and they will blame the rich. But it's not the rich's fault. It's a system that is there, and if you take your time to understand the system, you will understand that it's a hidden taxation that takes from the poor and gave to the rich. And we really should understand what this type of taxations through inflation means. And if you do that, you will also feel a lot more secure as an investor, because you know that because the market is rigged in some way, it will keep going up. But you still need to do your own due diligence to pick the right type of companies long term. But as long as the market is rigged and has been for 400 years, then you have a great opportunity in the asset market. Yeah. And this type of situation also means workers lag behind, and if the workers lag behind too much, if they push this too much, like they did here during the Kipper and Wipper, and like they are doing at the moment, maybe in some countries, then the workers don't feel like they're getting rewarded for the hard work, and people will get a bit lazy, etc. And maybe want to have make money easy, or don't have the motivation to work. And this can be intergenerational divides, obviously, because some generations might have the money and the next one do not get access to money in the same way. And basically this leads to system fragility increase. Small rate hikes can actually move assets a lot, and the marketplace gets really addicted to liquidity, as we saw during 2025, when we had sort of using too much of the reserves of the liquidity that the Federal Reserve have. A lot of people get a bit anxious about the situation, and suddenly, push, we have lower the rates, and we have the QE, quantitative easing, back from the Federal Reserve in USA. So this is the real deal. What I'm saying, you hear the history rhymes. The Kipper and Wipper is still active today, just in a different way. So the final lesson I want to bring to you today is monetary system fail. So when they fail, it's socially that they fail first. So the social part come first, and then the monetary came after. And you can say that the trust from people that breaks before the spreadsheets break, and that is some of that trust we are feeling getting hit even as of 2025, 2026 now. And we should be careful what to do about it. And we should also, um, everyone in every country now, be careful and demand from our governments that they should not push the liabilities and debt of the governments too far. And if they don't do that, obviously the quantitative easing of the central banks will also get lowered, and we can have a more sustainable long-term growth. Because if we push the debt too far and too fast, and we have it just to finance the welfare states, we will not have enough debt in the future to push innovation, etc. We will not have the balance there, and that will be very troublesome. And yeah, history explains markets, and this is what we have seen here today. So money that is not neutral, it has never been neutral. It will never be neutral. Money is, there are always rules about it, and if you understand the rules, the worlds tend to be an easier place to understand, and it will be easier for you as an investor to make money in the marketplace. You will feel more at ease. You will understand how the system is functioning, and why it long term is not just a lucky fluke. The markets tend to go higher because how the system is built, basically. And this is also explains why some people get richer and some gets poorer. So thank you for tuning in today. If you like this type of content, just drop a subscribe, like, and push the notification button, and search up some of my other videos. It's amazing to have you watching so far as you did, if you hear me saying that. So